Put the lights on.
Yeah, I think so. It becomes a bit.
Glaring, isn't it? Okay, no, let's you record already? Yeah. Okay, I think that's it. So we start off with some indicators this session. So what do you all know about indicators? Yeah, like the end.
Average.
Stochastic.
Yes, stochastic, that's right. These are the two ones we learned in Traders Basic, right? What else do you all remember? I mean, other than Traders Basic, have you ever read anywhere, like any other indicators? Or...
In my first part of learning trading, I learned quite a few.
Huh?
But then I started doing price action and dropped everything.
Oh, right.
Including MACD and stochastics.
Okay.
So I'm really learning them.
Okay, fair enough. Yeah, okay. What else? What other indicators do you all know? Do you remember any indicators?
Is it the moving averages?
Moving averages, support resistance, but you can call them as indicators sometimes. What else? Average true range?
Yeah, ATR.
ATR is another one. So there's thousands and thousands of them anyway. Yeah? So in this session over here, we will look at two main indicators. We can look at the MACD. And it's good to concepts here. And then point number two, then we will apply that in the market. And then okay. So there's three things that we're going to do. Alright, okay, so MACD, what does MACD stand for? Who knows? Oops, yeah, okay.
Moving average, convergence, divergence.
Okay, yeah, so MACD, yeah. Who knows the setting for the MACD?
20 and 80.
No, this is stochastic.
It's stochastic.
Yeah. Yes, sir? Okay, don't know.
Isn't it used with the...
No? Okay. The usual default setting is usually 12, 26, and 9. No? If you put it on your MetaTrader, you will find that the default one will be 12, 26. So, before we go into the indicator, what is the concept of the MACD? What does it do? Anybody knows? Silence. Okay.
I would say it basically gives you moving average of when it moves up and down, converges, diverges.
Yeah. So how is that?
So it can indicate when to buy, when to sell.
Yeah, of course, yeah. All indicators will tell you that. But how is this doing for you using these two averages? Out of the settings that you have, which are the averages? So,
Which are averages? All of them.
No.
26 and 12 then.
Yes, that's right. Yeah, 26 and 12. So all of the default settings is using the moving average of 26 moving average and 12 moving average. Okay, this is just the one to get this one. Okay, now let's go into detail about what this all means. Okay, so we have, let's say, here. Just make the right. So now we have a chart like that, okay? And then price is going up. Okay. Now out of the data that is collected, let's say I put a 26 moving average. 26 moving average means what does it do? How is the 26 moving average derived?
No, from the 26 period,
That's right. So if this is a daily time frame,
26 days.
26 days, no? Or to in another way, it is 26 bars because each bar represents
1 day.
a day. So to get a 26-day moving average, what the moving average really does is that it takes all the closing prices, because you can specify it, but most of the time, most moving averages use the closing prices. So it takes the closing prices of 26 days. You know what I mean? Of the last 26 days. Yeah, sorry. Let's take a seat. So it will take the closing prices of the last 26 days. So we got 1, we got 2, we got 3, 4, 5, 6, yeah? So just like that, you will add up all these 26 days, and then you will divide it by 26. Yeah? So closing price is sum of 26 closing prices divided by 26. Follow me so far. Okay. And then you give your value. Right? Exponential moving averages, which is what this method uses, is a bit different. It's not like a simple moving average. It's not as simple as this calculation. It will give a bit more weightage to the last closing prices. That's the exact formula. I can't really remember off the top of my head, but the concept is it's going to give more weightage to the last prices. So you use an exponential formula. Huh? But in essence, the concept still remains the same. It's taking an average of 26 days, but giving more weightage to the last price, which gives a value. Now, once you get that value, what's going to happen to the plot? So it's going to give you a dot, right? Based on where the value is. Right? Did you all get that last part or not? This dot, yeah?
Yeah.
Okay, who got it? Yeah, you explained it. How do we get this dot?
It's a 20. It's an average. It's a moving average is based on an exponential formula where more weight is given to the last days. It's not just straight arithmetic averages. Sum of 26 divided by 20 by the number of days, but it's based on exponential formula where more weight, so more importance is given to the last days, and then the result of it is it's a number, so it's a dot.
Which I understand, but how do you quantify saying that more weight is given to the last day in your equation? Like,
Yeah, so because of it's called EMA, exponential moving average, so you use the E. Yeah, remember the E?
Yeah, exponential.
E to the power. Do you remember that? No. Okay. So basically, in I think it's additional maths and which is A levels. You learn this E, which is like a ln as well. So it's an exponential formula, and that's how it does it. But in essence, you don't really need to confuse yourself more. So in essence, what you got to understand is a simple average formula is the one that I've written in here, right? Which is you find the summation of all the closing price divided by the 26 days, you will find the average. It's the same as finding the average height of all the people in this room. I'm going to add up all the heights of us divided by 5, isn't it? I'll get the average height, yeah. That's what it's doing. But in the exponential formula, it just gives more weightage to the last moving prices. That's all it's doing. That's the concept. But more or less, that number will deviate a bit from here, but not too much. Okay? But more or less, this will stand through the concept. So, out of that, you get a value x, right? So, because this is a y-axis and this is a y-axis, sorry, this is a y-axis and this is x-axis, so x, y. So, usually in your charts, the x-axis is what? What is it, Mr. Ponmusa? What is usually the x-axis?
It's the horizontal.
Yes, and usually what's the units then?
It depends.
Yeah, very good. Depends on what.
Depends on which thing you're using. For example, it can be mile versus hour, for example.
Miles versus hour. No, I'm talking about the charts, your currency pairs.
All right, okay. So,
So what would the x-axis be?
like one of the currency.
Yeah.
And what will be the other currency?
Any currency.
Yeah, any currency.
What do you mean? So what the x-axis would be?
So like Euro USD.
Yeah. So that doesn't mean x-axis. Who else wants to help him out? What's the x-axis?
Time.
Time, right? But this is a daily time frame. So what's going to be? Days, right? Yeah.
All right, but yeah.
Yeah. So it would be days. So you would have 26 June or something like that. Yeah.
Yes.
25th May. Yeah. But of course it will go 25th June. Basically one day by one day. Basically.
Yeah,
Okay.
depending on the one day or
Awesome. So now the y-axis over what will it be?
Day?
No.
no,
X-axis is day.
It's the
Why?
currency. The currency.
No.
price.
Price. That's right. Would be the price. The currency price is whole chart, right? So there'll be price, and there'll be this. Now, because I got this X now, right? So on the chart, it will be on the specific date and that price. So that's how the dot is formed.
So it will be on the day we are
The last,
calculating.
because you see, the moving average will always be the last 26 days, counting today as the first day. You get what I mean? Yeah? So the next day, let's say, it moves up a bit now, yeah? What will the moving average do now? Yeah, but what will happen to the dot? Where will the calculation start from now? Yeah, from this one, right? Yeah? Further over?
Yeah.
Yeah, it will start from this day, going all the way up to 26 days before, so maybe probably you stop here. If let's say from here to here is 26 days. But for the previous day, it'll be from here to
There.
let's say the next day it does that. Then it's going to take here to here. You get what I mean? Yeah. And it's going to average. So like that, the software will keep putting dots, and then what does it do to the dots? It joins it. Then that's how you form your
Yeah.
moving average that you see on the chart. So far, okay. Yeah, we got this part. Who's unsure?
So you are describing how the moving average
It's
is
moving.
formed.
Because we're going through the indicator basically. Right? Got it so far?
Yeah.
Okay, over.
Yeah.
So this is how we form the 26 moving average. This is 26 bars. Now going on to the next one, which is 12 moving average. How do we form the 12 moving average?
The same on 12 days.
The same, just like this 12 days. So then you go also form the 12 moving average. Now, so since you all understand this concept, which will move faster, the 12 or the 26?
12 or
Why?
because it's short.
It will be
It's shorter.
why since it's shorter it must move faster. Why?
Because it's less, how can I explain it? There's less inputs, I guess, so less stops. Within
At the end of the day, what is all calculating? What is both of these moving averages calculating?
average closing price.
Yes, the average price is calculating, right? Yeah. So when will an average be affected more? When there's less data or more data?
I would say
When it's lesser data, why?
It's more dynamic. It's more-
See, the more sample size you have, yeah,
it would be more
It will be
accurate
smoother.
over
yeah, it's over.
It will be smoother. The
Yeah.
price averages will be smoother when the 12 in the range
That-
will be bigger.
That's a good point as well. The 12 will be more erratic, the 26 will be more smoother. But remember that when your average includes a bigger sample size, it takes a big price shock to move the average, right? Think about it in terms of mathematical sense, yeah? So if you think that the average of, let's say, 200 days is, let's say, or let's just put maybe height. Let's say the average of 200 boys' height is 2 175 centimeters. Yeah, let's say the average of 200 boys in a classroom is 175 centimeters. Now, tomorrow you get a boy who is 190 centimeters. Now, adding 190 centimeters to the total of the last 200 boys and dividing by 201 on a mathematical calculation, will it affect it that much?
No, very little.
Very little, but compared to, think about it, there's only 3, right? There's only 3 boys in the classroom, and the average of 2 boys, let's say one guy is 119, the other one is 118, and then suddenly we get a 200 centimeter boy coming in. This is definitely going to affect the average of 2 boys compared to 3 boys, right? Yeah? Because the average is not maintained by a bigger sample size. So one small variation will make the moving average move fast.
Yeah.
So therefore, we will know that the chalk moving average will react faster. Right? Now, is that a good thing or is that a bad thing?
I think it's a good thing.
I think it's, I'll probably say neither.
Okay, why is that?
Because there's a reason that they have the 26 and 12. I guess more moving averages gives you more information. So if they both concur with a certain trend, that's going to be more accurate.
Yeah, okay, so we're seeing a couple of things again. Shorter trend, longer trend. So what are we looking to measure in here? What is the pros and cons of this 12 MA compared to the 26 MA? Based on what you've learned so far on the simple understanding.
Say in a short period of time, you know, if you want to, let's say you want to spread bet on it in a short period of time, you might get, it gives you quicker results based on a short period of time.
Let's think about this. So one thing you understand is that if there's a price shock, the 12 EMA will move faster than the 26 EMA. Right? Now, if you know that means one of the good advantages is that it reacts more faster to price. Therefore, you'll be able to catch a reversal much faster. But however, the disadvantage of that, it will give you false reactions, right? Because you know that one additional data will alter the moving average and may give you a false reversal signal. Right? So you may think that just because the average goes down, it's going short, but it's actually just a false signal. You're going in short even more earlier than you're supposed to do. Whereas on the other hand, what do you think is the advantage or disadvantage of the 26 MA?
If they're aligned, then you are sure.
No, just the 26 MA compared to the 12. I'm not talking about both together. What's the advantage and disadvantage?
So long term, so it's more less. It's more short track. So if going up to 26 days, the more sure that it is the trend upward.
That's good. So it gives you reliable signals. It doesn't give you false and reversal short. Nice short. What else? What's the disadvantage?
It doesn't recognize changes in the issue.
That's right. Yeah. So it all comes down to, it's not about. So it all comes down to not about whether you're using a 12 or 26. It depends on what objective you want to reach. And then you use the appropriate tools. You see, for example, if you want to fix the cars, if you want to fix tires in the car, right? You're going to use different instruments as compared to you want to fix the engine in the car, isn't it? Yeah. So understanding what objective you want to reach, then you use accordingly the tools that you want to use as well. Okay, this is what you're going to understand. Remember, all these indicators, they were designed to use according to the problem that you have and the solution that you want to solve. And third, they were only supposed to be used once you understand what the indicators do. Is, for example, your calculators that you use today, right? You know how to calculate them manually anyway. Like, let's say if I tell you to calculate let's say multiply 25 times 35. You know how to do it? But you can definitely work it out on a paper, right? Manually, yeah? We learned that, isn't it? But of course, you don't want to keep doing that all the time, so that's why you got a calculator. I mean, to make it more easier, the same thing with the indicators. Huh? To make you identify more easily, then we have the indicator. So you don't need to keep figuring out what the momentum is. Now, since we understood what the moving averages are, and what they do and what the advantage and disadvantage is, so now let's see how this indicator is using both of these moving averages. Huh? Okay? Any questions so far? Only just came in. Okay, good. They're all experts right now, so they'll be able to explain to you this. Like a question and answer session. Okay, good. Oba looks very worried. Okay, good, okay. Right. So we have the 26 and 12 right now. So now the MACD is going to be derived from this two moving averages. So we have the 26. Which one should we have at the top for this diagram? 12 or the 26?
On top, me.
If I want to draw these two moving averages over here, which should be on top, the 12 or the 26?
26 would be on top, 12 on.
Okay, who thinks that?
Oh.
What's the difference?
What do you mean, what's the difference?
I mean, which one is on top?
Of course there's a difference. Okay,
I
that's a good question.
I would probably say
12 would be on top. Sorry, I changed.
I would say 12, based on your explanation, as in, it moves higher or lower, based on less data.
That's right, yeah. So you're saying it's reacting faster, so 12 would be on top. What do you think, Mr. Moore? So basically, we're going to draw something like that, yeah? So which one will be 12, which one will be 26?
12 would be on top, 26 on.
Oh,
Okay.
you mean on these graphs you drawing there? This line.
I'm assuming that looks like an uptrend, so 12 would be on top.
So you are saying the same thing? 12 on top, 26, yeah.
Yeah, but at certain points, both of them will be on top and bottom. At certain
Okay,
points.
but on a general basis, on this curve, on this chart,
So the short part, 26.
which one is top? 12, is it?
Yeah.
Or 12 this one? 12 this one, yeah. So most people are going for 12. Yeah, I think as Oba explained, it's very good. So basically, because remember, this one is the one that reacts the fastest, right? Yeah, so this should be at the top. This should be at the bottom because it's lagging behind. No. And it takes a lot to move it. Now, based on this statement, there's a sharp move down. Of course, this will start reacting, go down. And that's when you get the crossover. Understand?
Mm-hmm.
Okay? Right. Now, the MACD, what it does is this. The MACD compares the difference between this 12 and 26. The difference between these two moving averages. What does the difference tell you? Okay. You know what moving averages are? Yeah. So we're just going through the MACD difference between the 12 and 26 moving. What do you think the difference between the gap between the 12 and 26 will indicate to you? Who else? Sasan. No? Well, if you understand the concept, you should be able to figure out something, infer something.
In terms of your decision, as to whether you can.
No, forget about decision for the moment. Let's find out what is it telling me. What do you all know so far? You all know that the 12 moving average is calculating the average of the last 12.
Yes.
And the 26 moving average is calculating the average of the last 26 days. And we also understood one thing as well, the 12 actually reacts more faster than the 26. Because of the number of data points that it requires to get the average for 12 days as compared to 26. So if you want to introduce one more data point to either one of them, the 12 will react more faster than the 26. So knowing all that points, what does the gap between the 12 and 26 tell you?
It tells us the trend. I think it widens.
Very good.
It can show that the actual price is moving higher. If it was going the other way, if the top moving average starts to slant down and the longer one increases in gap, it actually changes direction.
So there's a strong upward movement now on this at this point. I mean, price is going up, right? Right. Significantly going up.
So what does the gap tell you? The gap tells you the trend strength of the trend.
Yes, it does.
Okay, what else? In terms of a raw, on a raw level basis, what does it tell you? Even before we start inferring trend and all that. What does the moving average calculate? It calculates the of the okay, the 12 moving average calculates the average of the
12 days.
12 days. 26 moving average calculates the average of the
26.
26 days. So the gap between them is actually the difference of the
Prices.
What did you just say? Difference of the averages, right? The difference of the averages of these two periods, that's what I'm saying. So let's say the average over here, let's say it's what, 15.96?
Yeah.
No? Average over here, let's say it's about 8.96. The gap is simply saying the difference between this and this. On a raw level basis, right? So the gap between this and this is how much? 15.96 and 8.96. Huh?
I was going to say roughly about 8.
About 7.
It's 7, no?
Yeah, 7.
15.96, 8.96, 7.
7.
7. So the difference is 7. Now, basically, there's a difference between the two averages, isn't it? That's all it's doing. Now, what can you infer from that then? If, let's say this is 7, this one would be less than 7 or more than 7?
Far less than 7.
Far less than
Maybe
7,
one.
right? Am I right? Now?
Yeah.
Yeah, probably about 0.5. Now over here is past 2 item. Then let's say 1. Finally it goes up to 7. Now the MACD has got 2 lines in it, isn't it?
Yes.
The MACD is made up of 2 lines. What are they?
The moving average.
What does it mean? Come on. MACD is made up of 2 lines. What is it? Starts up. Oops.
Moving average and indicator line.
Yeah, you got one of it, right? Indicator line. What's another one?
Oh, the closing price.
No. One. When was the last time you looked at the Traders Best Candle? Okay. MACD line. Okay.
Okay, so it's MACD line. So what are the 2 lines?
MACD line and the indicator line.
MACD line.
And the indicator line. Okay? Yeah. So the MACD line, what it will indicate is the gap between the averages. So we saw over here, it will have an x-axis over here, because remember the chart is on the top, the indicator is at the bottom now. So over here, what it will have is a middle line, which is a 0. Anything above the 0 is a positive, anything below the 0 is a minus.
Yes.
So let's say we start from here, this point onwards, 0.5, so it's going to be above the 0 or below the 0? Huh?
Above the 0.
Above the 0, right? So here, then, there's a dot over here, no? And then after that, 1.5 is going to go up, right?
Yeah.
Alright, yeah?
Yeah.
Then it goes up to 7. Now you can see how I'm drawing the MACD line. Yeah? That's how that happens. And then after that, let's say over here, when the price starts to drop, this also will start to drop. It will start to cross over, such that it becomes to 0. Then it will start to come down now. Get what I mean?
That's the MACD line, yeah?
Mm-hmm. So, when the MACD line comes to 0, what does it say between the gap between the 12 and the 26?
0.
It's 0. There's no difference
It's
between
not
them.
different.
So probably over here, when the crossover happens, it is
0.
0. Right? So that's when it starts to go down. Now, so what can we infer when the MACD line starts to deviate a lot from 0? That the difference between the moving averages is widening. If the difference between the moving averages is widening, what's happening then? The momentum is starting to increase. But if it starts to increase, if it starts to get to a peak level, which is quite large, what usually happens? Yes, you start to go down. Why?
Because
Let's say the average price of a MacBook Pro is £1,500, right?
Mhm.
If let's say right now the price goes up to £5,000,
Yeah.
as opposed to if the price went up to £2,000, which is got a higher probability of coming back to its average. So £2,000 or £5,000? Let me ask you a very simple question. What product do you like to buy when you go shopping? You like buying handbag, dress, handbag, right? Not handbag, right? Product? Which one? No, I don't like product.
Right, yeah, product.
Okay, so let's say the Prada bag average price you usually see is about, let's say, £5,000. Okay, and let's say now when you go to the shops and you look at it, it's about £15,000. Is it very much higher than its average price?
Yeah.
Usually the average is 5,000. Right now it's 15,000, so it's much higher than its average price, right? Will you be inclined to buy it right now? It was? Yeah, 1,005, yes, but it's 15,000 right now. Would you be inclined to buy it? It's so much more than the average price. It's 3 times more than the average price. Probably not. And there'll be 100 more people just like you thinking the same thing. So when 100 other people are thinking that it's so much more deviated from its average price, what's going to happen to the price?
The price will go down.
Why? But why will it go down? Because
People are not
No one is
people are
buying.
not buying, so therefore who's getting affected?
the sellers.
Of course. The shopkeepers are getting affected. Oh my god, man. They're all going to be like, oh no, I'm not making any money, right? I need to bring the price down because nobody's moving on it. So that's when, so this is why the law of averages is such that when the price deviates so much from the moving average, the collective amount of people don't want to buy it anymore because they all think it's too expensive, right? Common consumer psychology, there's stood through time, isn't it? So when it's so much higher than what its average price is, then what's going to happen? No one's going to buy, shopkeepers not going to make any profit. So what? The guys who control the price are going to bring it down. So then price drops. The same thing over here in the MACD, but the gap starts to increase and increase and increase and increase. Because what it's saying, the averages are increasing in value of the last 12 days and the last 26 days. Right? The average that stood through 26 days and the average that stood through 12 days is increasing. That means short-term average is increasing more than 26 average, which is more stable, isn't it? Because the more number of data points you got, the more stable the average is over time. Remember that if you calculate the average standing price of a property over the last 200 years, it's more stable than when you calculate the average price of a property over the last 10 years. Am I right to say that?
Yeah.
So if the short-term one is deviating so much from the standard stable one at the bottom, at some point it's going to keep going and it's going to drop because people are going to start thinking that this is so much more expensive. But depending on your objective and your strategy, which you then design the rules for your crib sheet, you then have to then ask yourself, how long do I want to stand in the trade? Depending on how long you want to stay in the trade, you then choose your moving averages, and through the moving averages, then you choose the difference in the gaps of moving averages. If you're a long-term investor, I definitely won't be using 12 and 26. Right? I'll be using maybe something like 250. A 50 moving average to 200 because I want a stable moving average and also another short-term one, which is then correlating with the 200. So it all depends how fast you want to get in, how fast you want to get out. So depending on all that, then you use your moving averages. So this is for really short-term trading. So we use on the 12 and the 26, so we can MACD usually offsetting. In essence, what it's all doing is comparing the distance between the moving averages. When it starts to cross over, the gap becomes 0. Understand? Okay? Now, what is the other one meant to tell you? So one thing we can infer from here is the gap increases more and more. There's a very high chance of snapping back. And another thing we also see is that we also points in the market start happening when the what? When the value gets near to 0, that's right, yeah. And the crossover start to happen. That's when reversal points in the market also start. Okay. That's only one line, so how about indicator line?
Yeah, I was just about to ask you. So that was the MACD line, yes?
That's right. That is the, so in your default settings, 1226 line. So we covered both of this, so we understand now how this one, right? What's the last one? Yeah, what does that mean?
9 days.
Yeah, and this is what?
Moving average.
Yeah, of what?
Price.
Of price. Of this chart. Let's just say we went through that. So if you have 9, you probably must be on the top of all this, right? Because the fastest reacting now.
Yeah.
If the 9 is over here, then what is this MACD line going to reflect? All the 3 of them, but I already told you that the MACD only reflects 26 and 12. Where is this 9 missing piece going to fit in?
I'm going to go and say your indicator line.
Yeah, that's right, it's an indicator line, but indicator line based on what? This 9, there's a missing number 9. What does it mean? Any guesses? So?
It's not quite an average of the two lines, is it?
You getting there?
And we are dealing with
It's an average of what, actually? It's an average of... Okay, you know for some parts of it, right? So it's 9, and it's a 9 moving average, but 9 moving average of what?
What's the difference between?
No.
It's 9 days.
What is here? This is your... So what is this line that I draw? What is this? This
So
is
the MACD line.
That's the MACD line.
Yeah.
So the 9 is the moving is the average of the
The 9 days of the distance.
MACD line. That's right. Yeah. The 9, the last part of the equation, is the moving average of this MACD line.
That makes sense. Moving up to the MACD line.
Yeah. It's usually done as a smoothing factor. That's all they're doing. Usually, most mathematical indicators don't have just two things. They always have one constant and a relative to the other.
Basically, what it does when you have the points here,
Exactly, it's spot on.
you have, and then it's calculating from the last 9 days. It's the difference in between those 2 points.
No difference, summing up.
It's summing. It's
Yeah,
the
that's how moving
average
average.
of this graph from
Okay.
9 days, moving 9 days, 9 days.
Why 9? Why can't it 12? Why can't it be 7?
Yeah, you can do whatever they want, but the default setting that they found that the best reacts is 12.
Okay.
Yeah?
And how will it show on the graph then?
Oh, so you just take the average of this, so that's how you got the 2 lines, right? So something like that. But remember, this is a 9 moving average, no? And this is the difference between that. So it's basically this crossing over this basically. That's what it's doing. The gap of this is represented by MACD. The gap of that is now looking at the 9 moving average. Of course, because this 9 moving average is derived from this line, so which is more lagging? The MACD line or 9 moving average? 9, of course. Anything that's derived from the other one will be more lagging. Yeah? Think about it on a mathematical perspective, then you'll understand why. You see, which is more lagging, current or average?
Average.
Average. There you go. Makes sense now, no?
Yeah.
Because that's basically. Hello? Oh, I'm not sure who's it? Manish. Oh yeah, Manish. Hi, Tiru here. Tiru from Master of the Markets. Hi. Just hang on, let me pass you to Rishi. This way.
So the source of the problem is that there's so much info at once, like you start from the reading.
Sorry to.
Yeah?
The line
Any
is
questions so far?
empty.
Any questions?
From using it.
How do you derive it, the N9?
The line MA.
Are they the indicator line?
Okay, so the line MA, as I explained
So
just now, is
you're-
just like the moving average, right? You're taking the closing price of the last drop day. So the same thing. So the line MA of this line will be taking 9 data points, and then you will draw a dot over here, then you will take the next, let's say this one is the next 9 most recent ones, then the next 9 recent ones, then you will start drawing from them. So,
Okay.
you got that?
So
Yes.
the 9MA is the indicator line.
Exactly. So it's more lagging, huh? More lagging. So now, how do we then use all this? So the usual, there's a lot of ways. Now, if you understood the way it was derived, you can start thinking of what are the different ways you can use it. Huh? But the way that we usually, one of the common ones that you can use is what is in your trader's basement book. So, this process. So whenever the MACD line crosses below the indicator line, that can be used as a sell signal. Got that? So when the MACD line crosses below the indicator line, that can be used as a sell signal.
Yes.
Yeah. And whenever it crosses above the indicator line, it can be used as a
Buy.
buy signal. Now, why is that? What does that all tell you?
Basically, the prices are about to dip, so that's when you should sell.
Okay, but in terms of what we've explained so far, why should that be a sell?
Because it's going to
I'm going to start.
Yeah.
basically.
Let's take a look at the overall perspective over here. Huh? So you see, what's happening here? Firstly, we have a MACD line which is derived from the gap between the moving averages. Now the gap between the moving averages is showing you this. Now the gap of the moving averages doesn't mean anything by themselves, only with a relation to the zero line. Okay? Now in relation to the zero line, if the gap increases more and more, that means the strength of the price increase is increasing. However, if the strength of the price increase is decreasing, it will start going below the zero level point. But there's a critical point over here because momentum, even if it goes below the zero line, can still be increasing on the downside. Right. So what we are really looking for is a change from up to down.
Interesting.
Exactly. So, but all the zero line will tell you is that whether price is on the upside or on the downside. Okay, that's all it's going to tell you. So now, so basically all we have is one line compared to the zero line. So now it will tell you the gap and the strength of the price on the upside or the downside. Now if the trend is up, then I'm looking at the upside on how far it's going to be from the zero line. I know for one is that the more and more it goes above the zero line, because of the law of averages, it will start to pull down. So, but before it pulls down all the way to the zero line, you can get an earlier entry. And because for the earlier entry, I can use a 9 moving average. So that whenever it starts dipping below that, I can start to short it and then keep on to the short as it goes below the zero line. So that's why it's giving an early indication to short. That's all it's doing.
So it helps you to enter the market earlier.
That's
than
right.
waiting until you get to the
Yeah, so that's one way that you can use. Another way that people will use is in reference to the 0 point, because whenever, remember that also one thing I pointed to you is that whenever market starts to turn, it starts to turn at when the moving averages cross over. Isn't it?
Yeah.
So good points of entry also is when the MACD line gets to the 0 line. You can start to enter into a trade zone.
Yes.
Yeah? Does everyone get that? So basically, if you got price doing this and it's coming down, right? Yeah. then it goes down. See, as a trader, to get the biggest profit margin, do you want to buy cheap or do you want to buy expensive?
You would buy cheap.
I want to buy cheap, so I want to buy near as possible to here. Now, I can only buy near as possible to there if the moving averages are also crossing over each other. No. That means the gap between them is near to
0.
0 point. So these are the sweet spots. And also you can use the MACD, which is as soon as the MACD gets to the 0 point, you can then decide to buy cheap or to sell expensive.
So in both cases, we use the crossing line.
Yeah.
It's almost the same.
It depends on how you want to use it and where you want to buy. If you want to buy into a retracement, you can use the 0 line. If you want more confirmation, then you buy into buying signals.
The buying signals are also, sorry,
Yeah.
the buying signals, I mean, the best, one of the indicators in buying signals is when the lines are crossing. So that's where you would enter a trade.
Yeah, as a buyer. So yes.
So that's your second example.
Yeah.
And then the first example, you would enter again at the crossing of the lines or closely above or closely below, whether you buy or selling.
Exactly, that's right, yes.
So,
Okay. What else? What else you want to know? You know, the best way to always learn is one is theory, right? Another one is what? Put the indicator, yeah, exactly. Put the indicator on the chart and see how it reacts according to price. And then test your theoretical knowledge on how the indicator is working. Screen time, you cannot escape screen time. You always have to put lots of screen time. I can keep talking forever, but unless you have screen time, you won't understand. Okay, what else?
I didn't want to interrupt you because you're giving us the basis
Yeah.
of how they are derived. But if I try to remember the practice looking at charts, by the time that crossover takes place, in theory, which is where one should enter, if you look at the price, probably it's shot up already.
Good point.
In other words, that happens much later. So when I'm trying to get that, I'm learning how it's derived. When I look at charts, by the time that happens, price is
But you
gone.
see, but now that you know how it's derived, then how can you enter before the price shoots up? You see,
Yeah,
one is
so you-
zero, huh?
it's before it reaches zero. It's when it starts coming down. So then you would enter even earlier.
Good point.
On the
So
basis
you
of
watch,
what you
so you
said.
watch the indicator.
So you would enter maybe not at here, but you would enter even closer because you know it's close to getting under. It's already on the way.
Hmm.
Now is that right?
So I suppose when what's the
No,
this
it's
is
not,
just to tier it.
Hmm.
You keep an eye on the price.
You see, there's a couple of things over here now. So let's redraw all this here. And we'll move on to this. Now you see, you can understand. There's a couple of things here. In theory wise, sometimes you may sound okay and easy, but then when you go on the charts,
It's
The
another
theory
kettle of fish.
fail to stand true. And that's when you got to revisit the theory back again. So let me draw just all of this without all. Who used to do mathematics? Who used to like mathematics?
I used to.
Okay. You?
Me, I was only as good as it for as long as I'm doing it.
Okay.
So when I stop, I forget. So
Yeah.
I like to
But
get
you
back
don't
on
use
it
your
and
nose.
come back.
Yeah.
Yeah.
It's all conceptual, that's all it is. So now let's take a look at this one here. So, see. Okay, so we got 12, and we got 26. Okay. Over here, let's say price starts to top off, the gap will start to reduce. Over here, maybe it could be this, maybe. So now, then it starts to come down. Price starts to come down. Over here, gap is then comes to 0, right? Yeah, and then it starts to descend down, right? Yeah. So at this point, we have got my MACD. At this point here, it starts to go up. At this point here, we start to cross over. We'll start to do this, right? Let's say the trend of momentum is up. So I wouldn't short this because I follow the trend now. Am I right to say that?
So repeat that.
Because the trend is up, right, over here. Let's say on this chart.
Okay.
So I wouldn't like to short this at the moment. Yeah. So I wouldn't take the selling signal. Let's say you only use the MACD in the sense of in relation to the zero line. Huh? If you want to use the MACD in relation to the zero line, every time it moves below the zero line, you do a short, you do a sell. Huh? Every time it goes above, then you do a buy. So over here there will be a sell signal here, but I won't take it because the trend is on the upside. So the 12 now moves like that. Huh? Okay? And now the gap is now increasing on the opposite side. Am I right? Yeah? So the 26, let's say, is something like that, stagnant, and then it moves like that. Okay? The 12 moves like that. Follow me so far, everyone? So now the gap is now increasing within 12 and 26. So what will happen here is also will start increasing. Got that so far? Okay. So then now, as the trend is still showing up, because the last swing low, let's still say it's not cut yet, so I'm still holding on to my longs. Finally, then we start seeing that the 12 then starts to move up because then we see some buying coming back, pressure, yeah? Then the 12 starts to react. Now what happens to this gap? It reduces or increases?
Reduces.
Reduces. So it starts going back now up. So now here is where, as a trader, I'll start to position myself, maybe to start, but you can use one of these signals to start buying it when it reaches the 0 point. But there's another way to enter as well. You wait for it to cross above the 9 moving average. Usually this signal will usually come later than the 0, like maybe somewhere around here. But now what's the difference between late entry and early entry? Late entry will give you more confirmation. Now it reduces your profit margin. Early entry will give you less reliability. Maybe you can get hit more, the profit margin can be more in some of the trades that you take. So you need the sweet spot. And that for that you need to test and test. To get the right combination.
Is that how the sweet spot name is derived? So it's an overlap of two things, isn't it?
That's right. So you want to find the right balance between the early entry and the
So somewhere between 0 and 9 would be a sweet spot.
what do you mean 0 and 9? Over here you mean?
Yeah.
Yeah, exactly, that's right. Ideally, you see, your best form of entry is even before the 0 line. Yeah, somewhere around here. But you can do that with price. And you can do that with the indicator line as well. So anytime that, let's say you deviate so much from the 0 line, you can start buying into it. Because the law of averages will tell you that there's only to a certain extent that you can go so cheap. Before people will start thinking that they can't go cheaper than that.
Yeah. So
Because the guys who maintain the price will start coming in. So for example, the like Tropicana juice and all that in Sainsbury's, there's only a certain extent you can go down cheap too. You can't go cheaper than that. Because if you go cheaper than that, then all the distributors and Sainsbury's and everybody will start losing profits, isn't it? Profit margin, yeah. So that's another way as well. So depending on deviation from the 0 point, you can start buying into it.
So, for instance, if it's, let's say it's gone ridiculously, that product back has gone ridiculously low.
Yeah.
So let's say the £1,000.
Yeah.
May as well start buying it.
Exactly,
Because
spot on.
you know it's going to shoot back up.
Spot on, yeah. Because there's only a certain deviation you can go down by, isn't it? Yeah. Let's say it's 1,500 by £1,000 already, so it's dropped by £500 already. You know, it's a 1/3 drop, it's a 30% drop. How much can it go? It can't go to 0, isn't it? Until it goes to liquidation. I mean, especially a brand like Apple, it's very, very low probability. You're always playing on probabilities. But of course, because you're playing on probabilities, so you don't risk the whole amount because of the chance that outliers may have black swan events. Right? This is why people don't really get the probability side. They get very confident, they get very greedy. Even the high professional traders. And that's where you hear all the horror stories of the bank trader, you know, losing like $3 billion, $20 billion. That's how it happens.
Because they what? Because they get greedy.
No, because they forget the probability of an outlier happening, like a black swan event.
Which is not good.
So for example, black swan event is something like the probability of Apple going bankrupt to 0 share price level is very low, isn't it? Am I right to say that?
That's
Or the probability level of a Barclays Bank going absolutely bust, right, to zero share price level is very, very low.
very unlikely.
But however, the probability lies to a very small extent, which is known as a black swan event. If you didn't consider that, and you were so confident you put all your money into it, $100 million,
And then it does happen.
and it does happen, you lose everything, right? So you never do that. Always counting for the probability of outlier. That is why risk management is always important. So anyway, so that's a MACD, so go and think about it, and also put it on your charts and see how it reacts, which we'll do after this session. Now,
What settings do you put for, like when you're trading daily chart? That's what for example,
just nice,
for daily chart.
Yeah. Okay?
So you use the default when you trade it or when you trade it with your advanced students.
Oh no, I don't use the indicators at all.
You don't use it.
But you can use it if you want to use it in a different way, but I don't use it. Doesn't mean you are coming with it.
But it's good to know how it's done.
Well, yeah, of course, yeah. Later on, if you want to design other strategies, then you know which tools to use. And that's how we do it. Depending on what strategy I want to take, I will use the appropriate tools.
Okay. So, let's say, for instance, you say you don't use them at all, but let's say, like, can you mix them up? I.e., have your MACD with your stochastic.
Oh yeah, of course you can.
Yeah, and so that.
Yeah, depending on how you want to use it.
Yeah.
I think a really good one to use it would be probably the deviation from the zero line. Start entering it even before it crosses above the zero line. Maybe you can do some testing according to that with the price movement as well.
So based on like the 20, I'm talking about the stochastic. So based on the 20, you know that's about when you start to buy. It's
Oh,
because it's
2080 is stochastic, right?
Yeah.
Yeah.
So I'm just in relation to that. So it's dipped below, let's say, 0. But let's say you had both of them on there. You would use that 20 as your, start buying.
Oh, that's a very good point because you're saying that you're using combination of both indicators now, right? So maybe the first one part of your rule is that the MACD line drops below 0. The second is that the stochastic must also drop below 20. So now you're getting two oversold signals, right? Because the MACD has gone below 0, the stochastic has gone below 0, has gone below 20. Then there's a good point about you can, and you test it, see how your results go.
If you say you don't use it, why are we then?
No, it doesn't matter. Listen, I mean, because of the objectives and the strategies I trade, probably I'm not using it.
Okay.
But depending on other strategies and other things you want to do, you may use it.
Yes, yeah.
Okay, right. Yeah. That's why you always have the right array of tools. Depending on what type of strategy I want to do for the future, I may use it as well. Like CCI is a good one if you know how to, if you know how to use a commodity channel index. Depending on what you want to achieve out of it. So, for example, on momentum breakouts, if you want to find out if a breakout is strong and will sustain its breakout, a CCI is good. Right? It all depends. You must know the tools, what they do. It's not the other way around. You're just using it just for the sake of it. You don't understand. Because once you understand how it plays, then you know sort of flaws of it as well.
Yeah.
And you know when not to use it.
Yeah.
But you'll figure all of it if you spend more screen time. You'll start finding out, like, oh, when it doesn't work, or why it working. Possibly specific questions.
Yeah.
Okay. Have you used the MACD before, Mr. Hassan?
I used it long time ago.
Oh, okay, yeah. Why did you stop?
6 months ago.
Oh, why? Why did you stop?
I'm not, I think, I'll explain. Last 3-4 months I'm not using at all actually.
Oh, why is that?
Lots of other things.
Okay, stop
I'll
trading.
come back here.
Okay, stop trading. Okay,
Yeah, stop trading.
so how did you find the MACD when you traded it?
I think when I used it, I found quite useful.
Okay, yeah.
Yeah, I found useful.
Were your entries early or were your entries late or sometimes early, sometimes late?
Sometimes early, sometimes late.
That's right, yeah. On an overall basis, what were the results that you're getting or you didn't really do it consistently so you don't know?
I actually didn't calculate use consistent.
Yeah. So one of the toughest things, of course, one is consistent execution. because your psyche is not made up that way, it's deviate from consistency.
In that if they are
Yeah, it's very tough.
Yeah.
There's very few traders who live with consistency. It's the same thing as in going to the gym and really maintaining
Yeah,
a
sure.
good diet or maintaining the exercise. There's very few people who really keep at it. It's the
Yeah.
same as the business entrepreneurs, right? No matter what challenges they face, there's only a few that keeps on going consistently, isn't it? Yeah. So it's the same thing in trading as well. Okay. So consistency, and on top of that, there's only very few people who would record and measure as well. So all this combination of things, then very few the numbers. That is why there are also very few people who succeed really.
But I stopped using it because I was told that it's so laggy. But from the explanation that you've given now, I think I have to rethink. Because I think it depends what you're trying to do. If you understand exactly how it's derived, depending on whatever strategy you're using, I'm sure it's useful in other strategies.
Yeah.
And in other strategies, it's not.
That's right. Yes. Okay, so there's much. But I think maybe let's quickly go through stochastic. Yeah. Okay. Then maybe the next one we can go through. Okay, so we got stochastic now. So, what are the two lines in stochastic?
18 to
Yeah, that's right. Yeah. It looks like that's Oba's favorite indicator. Okay, that's good. Yeah. So 80 and 20. So out of the 80 and 20, how is that derived? It's good. But man already. Yeah, that's good. Yeah. So now, how does stochastic derived? Do you all know? Anybody read?
you say combined or
Derived, yeah.
I can only really say how it's kind of used
Okay,
in
yeah.
its simplistic form.
Okay, how?
So for instance, let's say that product back, the price keeps rising.
Uh-huh.
So it rises, and so really once it hits 80,
No, it's not the price, it's 80. It's the. Remember, the indicator is a reflection of the price, right?
yeah.
The indicator lines are derived from the price.
Can we do the derivation first then, please, before we...
Oh, how we derive it? Okay,
Yeah,
fair enough.
please.
Yeah, okay. So we'll talk about how it's derived. Remember, the MACD is derived from the price, right? So the chart is always at the top. The MACD indicator is at the bottom, isn't it? Of course, because you've seen it a lot of times. You know that. We will put it on the chart. You'll understand what I mean. But basically, the price is always at the top. The indicator will be at the bottom because it's derived from there. Right. Okay. So, based on this so far, this is a quite simple one to understand. Stochastic, usually you can use a 14 period or a 10 period as well. Huh? Sometimes if you want to find out the right combination, you need to test and see which one reacts better. Let's take a look at this. Now, 14 period. And
days.
yeah, that's right. If you're using daily, then it's 14 days. So what it's all doing is, let's say this one is 5 days, right? So this one is 6, 7, 8, 9, 10, 11, 12, 13. Okay, got that? So we have 14 days. Okay, so you have 14 days now, huh? So all it's doing is measuring from, let's say this is the current one, right? From the current bar, 14 days back. Got it?
Yeah.
Let's say this is the 14 days back, isn't it? So from current bar to 14 days back, it's finding out in this mathematical formula where is the highest point, where is the lowest point. Where is the highest point here?
Last night.
Last bar. Yeah. Yeah? Where's the lowest point? Probably this one, no? Yeah. Now, from the highest point to the lowest point, so if I were to draw it here, this is the highest point, this is the lowest point. Am I right? Not something wrong here, no? Yeah? Highest point, lowest point. If it's taking from the highest point to the lowest point, it will consider that as 100%. Okay? Let's say the highest point to the lowest point, let's say, is 200 pips. Got that?
So it's probability, it's 80% probability and 20% probability.
No, wait, I'm going to come to that, yeah, very soon. So you can see the high, the low, let's say it's 200 pips, and now it's considering 200 pips as the 100% range. The 100% range. Now, then it's what we'll do next is you'll find the closing price. Okay? This closing price in terms of this 100%, where is it at? Is it above the 50% or below the 50%?
About
Above the 50%, right? Everybody got that or not really yet?
That's right. I was trying to see when you explaining.
Do you understand this point?
Yeah.
This 100% and this 200 pips and the highest point is 14 days and the lowest point is 14 days?
Yeah.
Understood that? I'm asking you, where is that closing price now in relation to this whole range?
Okay. Yeah, as I said, above 50%.
Above to 50%. Now, let's say if I were to say this point here, let's now put some figures in. So let's say this high point here is 1.6890. Okay? Got that?
Yeah.
And let's say this lowest point here is 1.6690. So 200 pips, right? Got that or not really? Yeah. Let's say this one, this closing price now is 16870. Is this more than 80% of this range? The closing price?
Yeah.
If you want to prove to me mathematically, how would you do it?
You would probably deduct that from the total.
From that?
From the total, as in the top figure.
Is that how you would do it?
Like, I would deduct the 6870 from the 6890.
So that's 20 pips. So 20 pips divided by 200 is? It's only 10%, isn't it?
So, is that £10?
10% means that means you're saying it's oversold, isn't it? If you put it in a visual perspective, you told me how can it be 10%, but you say it's above the 80%, right?
Mm-hmm.
So how would you mathematically prove it? You've done it correctly, just doing the other way around. How are you doing, Mr. Hassan?
That's 90% actually.
So how would you mathematically prove it to me?
If you say
You did it correctly, or just the other way around you did it?
So, deduct the 6890 from the 6870, share it by.
The whole range over here and this is 200 pips, yeah? From here, highest point is 14 days, the lowest point is 200 pips.
So if you deduct from 6690 and 6870,
Very good.
then it's come 190. 200 pips, 100%. So 190 pips will be over 90%.
Awesome. Spot on. Yeah, you got it? So all it's doing is 6870 minus 6690 is how many pips? So that's about 180 pips, right? So the range between here and here is 180 pips. 180 pips divided by 200 pips, which is the whole range, which is now 80%, more than 80%, right? So now the indicator line would be somewhere around here. Then if I were to, let's say now I start drawing this thing, yeah? Let's say the next day is somewhere around here. Again, it's going to measure this closing price of this whole range. Now, I will easily, just on a visual basis, it's just about 50%, isn't it? So you can see a quick drop. It's 50%. As long as this range doesn't change, we can just keep using that fluctuating. So I can draw it like that. Huh? So now, let's say now it drops more further to here, and it's going to drop more further down because it's gone below the 20% now, right? Yeah? So that's how we stabilize, that's how the stochastic is. Then again, it will reset itself. So for now, let's say it drops below the lowest point, it will reset, the range will now reset itself. So now we compare the lowest point for the last 14 days and the highest point for the last 14 days. And the range resets itself. then it will calculate the percentage accordingly. All in essence is doing is calculating the highest range and the lowest point of the last 14 days. It's having its range, and as a range perspective, you see where the closing price is, and then we'll take a percentage of that range. Okay.
So 14 and 10 are the default set, or you just pick them?
You pick them through testing. Usually 14 is a good standard. So what does this tell you? So basically all it's saying is that if for the last 14 days, if the price is above the 80% range, there's a strong probability that it will drop further down. But remember when the thing will fail. When will it fail? When will it not go down? When will it keep going up? When?
Once it's gone below zero.
Remember all the zero and all this is just an indicator, it's just based on price. Remember the indicator failed. If you had a simple rule saying that whenever it goes above 80 you're in a short, whenever it goes below 20 you're going to go long, when can it fail?
The price keeps going.
When the price keeps going up, keep going up, keep going up, the trend is very strong.
Right. Yeah.
Yes, that's right. The fundamentals are strong. People are just having more confidence in that price. They think that it's going to go further up, right? Let's say tomorrow, let's say they release a news that
Yes, I was going to say news.
yeah, let's say they release a news tomorrow that Steve Jobs is reincarnated himself, right? He looks different now, but
Oh my god.
yeah, but he's a different one. But the guy is a super genius, okay? Like
I
some
probably
people may
should.
not believe in reincarnation or whatever. It doesn't matter. But the point is that the guy is really super genius. He's as good as Steve Jobs. And then he starts reinventing the new set of technology that then Samsung is like thrown out of business and everybody is like loving it. What's going to happen to Apple stock prices? It's going to shoot up so much.
Yeah.
So they keep going up, keep going up, keep going up, keep going up, keep going up. That's when even the indicator shows above 80, above 80, above 80, it doesn't matter anymore, right?
It's target, isn't it?
Yeah,
To just watch.
exactly. Yeah. So just blindly relying on that will kill you, isn't it? That's why you use a combination of factors. But it will give you more confirmation if you want to use it. Usually indicators are very useful as well if you want to automate your strategies.
When you
Want to automate your strategies. Automate it so that you don't want to be next to the computer. But it's all further down the line. Usually I've seen the most experienced traders who really automate it is only after like 10-20 years of consistent results. And their system stands through all market conditions. And then they do not get all these programmers that you see on the internet, which is all rubbish nonsense. They get really, really highly skilled programmers which actually can program for you adaptable coding according to the market, and the guy will tell them how to do it as well. Institutions can continuously do this.
is that why they're able to enter early?
Oh no, that's got nothing to do with early or late. Just got to do with different coding levels of your automation as well. But you know, as retail level, depending on what objective you want to make, if you just want to grow your savings exponentially and so that you know you can achieve whatever financial goals that you have, then it's fine. Just stick to swing trading, stick to one, get it right, and just grow your wealth consistently. Okay. Okay, so the second part is what? Why do we apply these indicators and see how they react? Huh? You want to do that? You can share your laptops. What shall we start with first? Should we start with the stochastic or MACD?
Next week.
You want to start with MACD? Okay, start with MACD. What is it, Mr. Tan?
Yes. Today or next week or something.
Huh?
I'll do today.
Oh yeah, you just apply it for
All right.
20 minutes. Ask me any questions you got. You can share with them.
Okay.
Yeah? Up here, you want to share with them. Oh, you got a laptop yourself? Oh, really? You can do it yourself. Yes. You guys can be a dynamic duo team. Is your battery? Or?
No, I
Plug
don't
in
know
with
whether.
battery.
What I'm just thinking, I don't want to put the master.
Yeah.
I I suppose I can.
Oh, was it you? Okay, no,
I think it was.
very short.
Play with paper.
That's right. Interesting.
I'm just thinking of finding a new chat to play with.
We got a section. Oh my god,
You know?
it's not that long.
It's not that long.
See what it's like.
Give me the. Let me see what I can do. Oh, okay.
So there's no matter it's will use this.
You should have the other one.
Yeah.
I think it should do come. Let me check.
Mark 12, 26, 9, 12. Okay.
Yeah. Come on, change it. Change it to something because we have rights and brain.
Okay.
Some indicator.
Loops. Or something.
Yellow. Yellow is quite good.
Here is there.
No. That's like yellow.
Okay.
This no. Then the main.
What's
Then you have the main and then you have signal.
we're trying to do our settings.
What is the main in this?
Main which is C.
The
Main is the.
Yeah, signal line, the indicator line. Yeah.
Ah,
So,
okay.
It doesn't mean that. Silver should show us black.
Yeah.
or you can just put silver and then red. Put the signal as red.
Right.
No, we will avoid.
Oh, it doesn't matter, it's
Put
okay.
it red.
Oh no, you put it at the bottom. It doesn't matter. It's up to you. Whatever you want to use, as long as you know what it's going to show. Yeah, there you go.
So that's the yellow, yeah?
That's the indicator line.
That's right. Yes.
Oh, but that's cool.
Yeah.
No,
So this is indicator line, yeah?
the gold, yes, and the histogram basically because in MACD it shows the histogram, but you look at the outline of the histogram, get your MACD line.
Ah, so we are looking at
Yeah,
Always
exactly.
always show histogram and.
That's it. Yes, on the MetaTrader thing. Yeah.
But you can change that setting as well.
Ah,
You can change that not to be a histogram but to be a line. And
I don't think so. I don't think MetaTrader you can.
so it's an oscillator.
that's an indicator.
Yeah, you can use this as well, but you go insert, don't you? Insert indicator. Indicator. Oh, come on. Insert indicator.
Okay, not an indicator.
It's under oscillator. Not it.
Okay.
But we've got it already.
Yeah.
Yeah.
So then
So you can go to insert, but you can also go from there.
Mhm.
So where is the 20 and 80 here? Also,
Stochastic.
that's stochastic, I beg your pardon.
So can we put both at the same time?
You can do both.
Yeah, okay. That's why some traders just looks like a Christmas tree. When they got 20 indicators.
Oh yes, yes.
Too much indicators is indicating problem.
Exactly.
But now I've swung to the other end where I can use indicator before, which is bad.
That's a very big
That's all extremes. Not all extremes.
Yeah,
They
it's
help.
Oh.
It's just
Oh,
a-
is it? Oh, it looks very new.
So it's taking more time.
Yes.
Just gives you the
That assurance as well.
Yeah.
That it's just not. Yeah. Okay. So let's put this.
this
From here.
from it just comes as a package. You don't.
Oscillators.
go insert indicator and then
You got oscillators.
Why oscillators? Why oscillators?
Because they oscillate like
Yes, that's right.
sinusoidal wave.
Okay.
I did physics many years ago. Okay.
So I'm fine with the MACDs.
So Shu, can you hear me? Type in yes if you can.
Yeah, you're fine with the MACDs.
That's
It's just
so
the,
popular.
I've even got 50, I've got 80.
Are you guys still there?
So you've got the stochastic.
Okay, that's good. So you're asking a question. Is the difference indicating the volatility of the
We haven't
movement?
gone to stochastic yet. So, shall we try the stochastic?
Yeah, as I explained, the difference is actually between the moving averages. Huh? So the moving averages are then a reflection of the average of the prices, isn't it?
Yeah.
So you guys
No,
have
no,
50
it was
as well.
go back.
So in essence, yes, it will of course, because everything is a indication of the movement. Yeah.
Oh, right. What are the settings?
K period, percentage period.
Does that make sense? No.
Let me check what you what he's doing.
And then it has 5 and 3.
Yes.
3%. What settings do you want?
Okay. You know, right now, so they are applying all the indicators.
Yes, it's like one I've done earlier.
Yeah, the indicator line is basically
That's
an average of the MACD line. Okay, it's a line moving average of the MACD line according to the default settings.
and that's 50.
That's the default.
That's moving
Yeah,
average.
just put okay. Okay, no, I can't do it.
It's a line moving average of the MACD line. So when you got the MACD line, it's doing a moving average of the MACD line.
Ah, yes.
So therefore, because the moving average of that line, therefore it will be lagging. The line moving average will be lagging. So that's why we use the indication when the MACD crosses below, then we use it as a leading indicator.
And yet look where the price is.
But then so the crossover.
Let me put a. Can you see where the crossover?
Yeah.
Yeah.
And then we have the crossover here. So if we're looking at MACD line, the crossover would be here.
Now, what you can do to understand what you have done so far, then you can just put the indicators onto the computer right now,
If you're looking at the MACD
and then you can observe it and look to understand.
almost, it's between, not between the zero,
Yeah.
between the indicator.
So put the MACD line
and the MACD line.
onto your chart,
Let me open when
and then see how it reacts, so that you can get a better understanding of the theory now into practical.
No, that's, this
No,
is the
why?
MACD and that's the
I'm saying, how do I get that of mine?
Any other question, just type in.
Eliminate, remove that so that you've got a clear screen. Remove the market watch.
Maybe a good way, maybe to put everything into understanding what we've done so far, so what you guys can also do is put the 12 and 26 moving average onto the chart. And then look at the gap between the moving, yeah?
Shall we have like the
Let's see the gap between,
stochastic on the, because the default is 5 and 3, should we have the 12 and 26?
no, you don't need, no, stochastic you don't need, it doesn't matter. You can use 533 or you can use only periods, whatever you want to use. You can use 10 as well. 833 as well. 833 is a good one.
So 12 is already set in
So what I was thinking
past
is
EMA.
not using this because this is a lift off. Just get a chart, a blank chart. Put
It's
let's
the,
try
it's
it
the,
forward.
What's the general theory? What's the general default color for the 12?
Yes, for sure, that's right. 80 and 20 are automatically shown. Let's put a stochastic on it, you will be able to get it, yes.
What's the general default color for 12?
Or you can choose whatever that you want. You can use silver, they're using silver
That's
for the main.
Yeah.
And then for the
So what moving average? Did you say 12 and 26? Yeah.
for the,
Oh, you're using the wrong
12 and
it's not
26
easy.
not
Yeah.
taken.
So if you want to move the average,
Indication.
indicator, oscillator,
MACD is the one. No, the MACD is the one. That's it, yes. So go under
actually
colors.
moving average already. Once I go,
Yeah, that's it. Means that's not there.
no?
That's correct. So sure, that's for the stochastic, the 18 and 20, yeah?
Not Margaret. Can you see what Margaret?
MACD is a different indicator, okay?
That's it.
It's a trend.
If you put them on the chart, you will understand it.
Come now.
Hmm?
Which one comes now?
So 12, that is
This
the
is this is a MACD 12.
That will make sense.
Okay, good.
I will leave it there.
This one.
Yeah. And then this is then the white lines. Silver is the
But I mean, once we do it once, it's now on. So shall we close this?
Yeah, so my questions for you too is not so much about this, it's about, okay, first one is apps.
Okay.
What apps exactly? Also, in terms of like, I don't know,
You don't really need maths, though. It's just concepts.
and in terms of like training, like for instance, what would you recommend, or videos?
On the trading side,
Yeah, just kind of.
oh, I think first thing, let's get the basics right. So go through the trading-based maths again.
Yeah.
Yeah? Go through it about twice or thrice, or whatever.
So can I
Okay, you have the answer. Another thing that you need to do is go through all the strategy videos in terms of live trading,
But we can see here.
right? And then what questions do you ask us in these sessions over here? And then the next thing you can start reading tools. Yeah, like new market business is a good one as well. But if you really want to get into the nitty-gritty of trading systems, then you can start reading Van K. Tump's book as well.
That's what we use for the other.
Then there is trading the zones, like policy summary. Then you also can read
I think
spread betting, Malcolm,
That's
and
94.
Sorry? Okay.
Because I don't know whether when we hear.
Then there's a couple of good videos on YouTube. But I tell you what, do these two things first. Just trace this and do the Elders book is quite good as well. Elder. Trading for trading by the rules or something like that. But the first two things you do is trade based game and do
you were saying 14 and 10. remember?
Yeah.
This one.
and do the strategy. You go through the
Let's just try
videos
this.
like live trading.
Okay.
And
You
just
can try to become a line.
little Dropbox one, right? Do this two things first.
Inside. Insert. Look at inside.
Yeah, I'm asking.
Yes.
When we have in stochastic,
Yeah.
the properties is 533. So what is the
Yeah.
percentage K period, percentage T period?
Oh, the percentage D is
It's a line, isn't it?
yeah, it's actually a derivation of the moving average rather than 5. But you don't need to worry about that now. You just look at the number 5. Understand the number 5. 5 is the period of the number of days.
Instead of 9.
Signal.
No, don't confuse the 9. 9 is for MACD, right?
Ah, 9 is not. This is stochastic. I don't know.
Yeah.
Okay.
So it's
Okay.
5. So you're only looking at the 5 days.
So.
You're looking at the last 5 days, the high and the lower point of that.
Right.
Okay, so it uses 5 days.
So if you take only one on the scheme. and,
Yeah, okay.
Yeah, just keep on the scheme.
Oh, you want to say what?
No, no.
I'm going to change the color.
So then, because that's the signal, so it's that also stands out.
If you
Which one?
put only one,
That's our
The big.
K.
yeah, put.
So we're looking for primary at the blue
Now
line.
you can sort of check.
So that's what we.
I think the dotted line is the K. So,
In the
we
field,
get it blue
yeah.
line.
What would you put?
Yeah, 12,
Yeah,
12, 26, and 9 here.
Okay.
That's the main, that's what we do.
So we can say one line, isn't it?
Yeah, it's like that.
The main.
Let's change.
It's the darker color.
No, it's electric, 26,
That's the
9.
So here, we're looking at the T root.
Yes.
Is this one? Yeah.
Okay, so
Yeah,
this
that's
is
right.
5 days moving averages.
That's like line, isn't it?
Yes.
And here we have
So the indicator line is the red one,
12,
and the
12,
gold one
It's also.
is the MACD.
Yeah.
But then the MACD line you derive from the outline of the MACD. So
Uh,
So
Then we will have the lines and the top one is the indicator.
Yeah.
This is the red one, yes.
But this is the same, this is 26 and 12. So we have 12 and 26.
It's not only supposed
If you double click and
So
change
that's
it,
the
then
gap, so it's very,
just-
it's the same.
No, that's the line.
This one?
It's
I change
basically
it.
reflecting,
Oh, okay.
that's
See,
reflecting
How
this
do you
one.
difference?
So the different prices more.
The red one. It's
Yeah.
red one.
Red one, deep, probably blue one, for example.
So where we would enter,
And,
for example, right, how we would use combination.
These are the any, probably, yeah.
Yeah.
Does it just simply make color of it?
Let's ask you.
So that's 26, how,
Yeah.
how it
So this is MACD, and 12 and 26 reflects MACD. So
So
one,
there's nothing here, it's down like this. If you look it up here, there's nothing really, is there?
So you would first start paying
How
attention
would you
here,
know
or
what's
even
low
ahead.
to?
But then,
Why not? I mean, this is what I was telling you. Because basically, you need to
go
look at the trend first.
down.
And then based on that,
Oh, sure.
you can use that from what I explained in terms of the moving
Yeah.
averages, how to make it around, whether it's cheap or expensive.
So then we would
Yeah, but that means
definitely
people-
start
people
thinking
here.
about going short here, or maybe even earlier.
Yeah, but how can we know that money is actually costing?
So it's going
Small
down, yeah, the
Yeah.
price is still going down, so.
Well, you're looking at a
Prices
small
started-
primary
prices started going
What
down
did they
here.
each one?
When
We
we
saw
start
one day,
saying-
yeah, they, yeah.
That's why I do look right.
Yeah, yeah, that's true.
Yeah, it's probably about
Right,
here.
so
Yeah.
It's kind of, crosses
Now it's
here.
10:30.
It's like
Change it to-
crossing-
No, it's fine,
Going
26
above
right?
us and crossing here, we're like feet apart.
Yeah,
This is making sense?
We are using, the chart we are using is not very helpful. Because this period
Okay.
is concerned.
No.
So maybe who has understood it?
Nice trending.
That's right, yeah.
Nice
she got two
trending.
So that's not, you know,
Yeah,
you know
that's
what's
right.
happening here?
Yes, yes. No, yes,
That's
I know,
not-
that's right, we are right.
No, not
But it doesn't.
Okay,
it
so
doesn't
maybe
have
what we all
much
should
to do
do,
with it.
Oba, is that making sense to you?
So the map,
Yeah.
which, yeah.
Okay, who's it making sense to?
Here, we put 12 and 26.
No, because you got the 20 average is low here, so you buy, you watch, you just ignore it.
Yeah, no, 20 is below. You see, a
Yeah.
couple of things. Let's not just look into what we want to do right now, but let's understand what the indicator is doing. That's all we're doing.
We put 12 and 26.
Yeah,
So, I was just saying to
Yeah.
Kiata that
It's
unfortunately,
below, that means you run.
we are looking at the GBP and ES treatment, not short.
I think it was,
Does.
How do you
Yeah.
understand
Yeah.
that?
but this is trend.
so okay, you tell me, how's the negative impact? Okay.
Yeah.
But that's the difference. In here, we manually put 12 and 26
It just
on the
below
averages,
that,
and that's the
below those
difference
two.
between
Between
each one on
five,
the, on the screen.
Yeah, which is the 12.
So, 12 is the green.
The green one, yeah, and the blue is 26 now.
Japan.
Yes.
So the difference, when the 12 goes below the 26, will it be
Yeah,
negative?
you find out.
Will it be positive?
Yeah, find out.
Okay.
You know, you-
Huh?
For example.
Should be negative, right? Because why? Because it's you're taking this number minus this number, no.
That is US, that's the.
That's how the number is.
Yeah.
That's
Come
why
on.
the
This one
negative is at the bottom below zero.
That's okay.
Oh yeah, because I'm
Ah,
doing it. Okay, yeah.
Because we have
That's
touch
true.
screen.
So,
It's funny.
I'm catching it
Yeah,
myself.
also
like
like
this.
Yes, and then.
So basically, all it's showing, if you can remember what I explained to you just now, the gap between the moving and market
yeah.
is the
Yeah.
gap between
Yeah.
the zero line and here.
That is the point. that-
And that's all it's here. You see now, look, when the gap reduces, it's getting nearer and nearer to the zero line.
And it also crossed here as well again.
Whenever the gap reduces,
There's,
No, no, also
That
it's-
is, that is 100.
That
So
will,
it's 20.
it's likely that will cross zero line.
yeah, it's usually a reversal point, right?
Yeah.
So in the direction of the trend. So this trend right here, if you look at it, it's a downtrend. So now it's finished retracement.
Trend is
It's a
down.
month,
Yes,
a
that's down, but
month,
it's crossing.
and then it will further maybe go further down.
It's
Depending on momentum strength.
But my question is really, how do you combine reading both of them?
Combine, oh, the stochastic effect.
Yes.
Okay, so for example, if you want to, now what you want to do? Now, everything is depending on trend, right? So you want to do what? You want to sell or buy now?
Well, if we're going to buy, because it's going
Why you want to buy?
reversal.
It depends on trend first, right? What's the
The
trend?
trend is downwards.
trend is still downward, but because it looks like it will go upwards.
So no, it's
It's
not
only
like
the
that.
trend.
Looks,
It was only the
just
trend.
follow only, yeah, exactly. You follow the trend, yeah.
The trend is that way.
Trend is
It was
down.
just
So during the retracement, you don't do actually anything. You just
wait. Yeah.
But there are other strategies to trade retracements as well. But you shouldn't do that anymore. Okay. So right now, so since the trend is down, you wait for the retracement to finish, and then if you want to use both of them, what you can do is that you wait for this to, let's say, get nearer to the 0 line, and also wait for this to get to the 80 line. So this both of this maximum is picked up and overbought, and it's next to the 0 line. That's pretty much what.
So like in looking backwards, because here we don't know what's going to happen, so looking backwards, that's boom.
It doesn't matter. Okay, use the mouse and use
That's
it.
closing.
See, look, you can observe, right? Look, okay, now I'm not going to tell you, but look at the last time when the market went back in onto a downside, and how did the indicators react to that?
Like here.
Very good. What's happening then?
But it's short down indicators.
No, why? You do one by one. At that point, what's happening to the MACD? At that point, what's happening to the stochastic? Forget about all of this. You shouldn't see all of this.
Yeah, because it's in the future. We don't know.
That's right. Yeah. So at that point, what's happening? Is what you got to see. What's happening to the MACD?
MACD is crossing the 0 line.
Why is it crossing the 0 line? Because, and also look at the histograms, right? It's almost what? Not
It's
exact.
almost 0.
Why is that?
It's not
Not
it's
a
price.
There's no difference, not in price, between the moving average. That's what I explained before, right? So there's no difference between moving averages. It's just coming to almost 0. Because you see, whenever the market reverses, then usually the gap becomes 0.
Yes.
Yes,
Until the other one was underneath.
exactly.
Like from here, they were all parallel. And
Yeah.
then here, that went down.
Because usually the market compresses before it starts to burst out. When the market compresses, that means that both the moving averages, the long term and the short term, gets nearer to each other.
Yeah. What happened to gold, etc.
Yeah, so you can see all of that when you go through it. And the stochastic, as you can see, that because of the retracement, it goes above 80, so it's over. So basically, the range of this, the close of this, comparing the last range of this, a low and a high is the highest one. Which is good for us because it's indicating less expensive.
So the stochastic is indicating that it's
The height of that bar and the low.
That's it, yes.
Yeah, it couldn't carry on the retracement.
Okay. Okay. Okay, I think. Of course, like at least you understand, right? Yeah. At least you got indicators. You understand which the indicator line is.
Yeah.
Yeah, right. No, really.
What I don't understand is that how do you determine when to actually buy or sell?
Right. Yeah. You see, when to buy or sell is always a combination of factors. It's not just one.
Not just
It's not just one this. But there's a few signals that you can use to buy or sell. This was explained before.
Indicators.
It's about the MACD line and the indicator line. The MACD line crosses below the indicator line, then you can have a sell
Stochastic.
signal. So we can.
Yeah, but the only problem is that what I've learned
Yeah, you said you really
is that normally when you've got the 20-minute average that's below here, you don't.
No, that's the lift-off strategy. Don't combine, don't confuse
yeah.
both.
Okay.
This is just learn it from the indicator perspective. That's what today's topic
That
is.
is strategy, yeah, I forgot to do it. That is the what is strategy. So that is strategy for different principles to follow. But this is in general how to use the indicator.
Okay, so when it's low like this, then it's good.
Now, it's not that it's good. You need to understand the whole indicator. That's what I'm explaining that.
Sorry?
And then use it for
You don't know this.
the indicator. Use it.
I am not.
So what I this is to be oversold.
No. Don't confuse that. It's MACD and the stochastic. The stochastic is oversold. It's not the MACD. The MACD shows you the difference between the moving averages.
What would I put the room?
How would you
Stochastic.
This one.
Yeah.
So what would I put here then?
533 is fine.
This one,
Yeah.
Or you can use 833 as well.
I'm just thinking the first time now I'm important to read that.
Let's see.
So there you go. So now you're right, because this indicator shows overflow.
One
It's above
close
the
to
18.
one is close to 80, I think it shows that it's oversold. Overbought,
Yeah.
like this.
Okay, so then it will start
Now,
coming down. Oh,
and
okay.
when it's 20, it's oversold and it's likely to go up.
Mm.
Okay, so the final part, any last questions you have for me in terms of live trading rooms, strategies, you know, like any topics?
We don't use any, do we use this in the lecture?
No, we don't usually. You can use that for intraday trading sometimes.
Yeah,
If it is above 80,
Anything else over? One of the
just one indicator.
Yeah. Are you investing your trades every day consistently?
Me?
Yeah, all of you.
I'm not trading.
Not started.
Oh, you're not? Not on the simulated account? Oh, why not? Huh? Was it?
Even in demo account, you can play.
But yeah, you're not losing
I
money.
think theoretically we are making a big mistake. I don't have money, right? Cash. But I should be demo. I mean, in trading,
Yeah, it doesn't
we
matter.
are blessed with a demo account.
On cash demo, you use your own money.
No. I'm being honest.
Okay.
We should demo, honestly.
I know.
That's a big one.
I know the reason why I'm saying it.
Wait,
One of the
demo?
reasons why I failed in my trading, I was keen to make money. So I didn't demo
It
trade.
can't
To
come
the
online
extent
and buy you, isn't it?
I did But I'm saying this for the benefit of some of you who are starting.
But
It's so important because you learn about empty forwards without risk. But half the time we are so keen to make money, and by so doing,
I was losing money.
we lose money, and our learning curve.
It's about 9
20
months.
years later.
One is
You could be
Yeah,
a
that's
year
all
or
over.
not
Check.
next trade now.
Yeah,
Oh,
I
really?
should start actually. I was hoping to start.
Yeah. Mr. Hassan knows how to place a trade, he can help you.
Sorry?
You know how to place a trade, of course.
Oh yeah, of course. I did lots of trades. Last 2-3 months I didn't them.
Okay, right. Fair.
But I did lots. Even one day I did 20 trades.
Okay.
When I'm looking in the living live trading, sometimes the lines on the chart of the teacher, whether it's you, whether it's Rishi, or whether it's Larissa, the lines on my lift off of dynamic are completely different.
Your moving average lines.
Let me show you what I mean.
Which one is this? Oh,
This one's
yes.
also trade. Yeah, that's
Maybe dynamic. Okay, you know those yellow lines, for example.
Yeah.
When someone is teaching, mine are completely different than and it's,
But they're using for teaching. Oh.
But which lines are you talking? The horizontal lines you mean?
yeah,
His horizontal lines will be based on swing lines, swing lows.
yeah.
So as long as you have them there, then you should be signaling correctly. But how are you
No,
going
but
to
what I do is when I'm watching the live trading, I have my laptop
Ah.
and I'm watching. And
Depends on the time frame though. Are you correlating to the right
no,
time?
sitting daily, like tonight at 9 if I was at home, right? It's about to start now, isn't it? I normally open my laptop so that I can actually see how it relates to what the price is actually doing. And I find that my chart doesn't look like whoever's teaching this chart.
Shouldn't be, but if it is, then just asking the question, why is it? Then just showing me your screen, you can check it. That's the best way to analyze it, right?
So how
Ask
do
me
you
right now, I don't
watching
know.
desktop? Watching desktop. I keep the laptop with you.
Sorry?
How are you watching? Watching on the desktop.
Yeah, I've got a desktop.
So you are watching on the desktop, but keep a laptop.
Yeah. I open my
I understand.
and then I watch. Sometimes, but now that I'm using Easy Forex, most of the things are the same.
Okay.
But the lines, sometimes they are not. Yes. So in any case, why are those yellow lines there on? Are they field levels? Yeah.
No, I don't know how you got this yellow. Who put for you this yellow lines?
No, it's just, they were just default when.
No, they shouldn't have been default. I think you have put them sequentially.
No, I haven't put that, sir.
This is 23.6, yes, that's a fifth level. Of course, somebody must have. Doesn't matter. Right, click. That's all.
So these are the lines that I'm talking about. If you, these we have to add one, don't we?
Yeah, this one's especially, you can just copy it from she's thing.
We just copy from the screen, isn't it?
Yeah, but his phones usually will reflect just this, what's the latest algos basically. So you just put the red for the most lowest and green for the most recent values. So that's how you do
Exam.
it. So check it from that perspective.
Okay, so I put the red,
I think
the swing low.
First thing
And the
what
other
you
one
do
is
with the
swing
green.
high.
Yes. Yeah.
And these ones, just insert them through the insert menu.
How do you copy?
Sure, yes, that's right, yeah.
Yeah.
Go
So
and what? And copy?
you can copy it as well. It's Control C, left click. Do Control C and left click.
Yeah.
Click, select the square first.
Yeah.
Control C and then, no, you got to you got to hold on to the ball.
What that?
Don't click on the mouse first. Click on Control and C at the same time. That's it. Yeah, and then click. Yeah, and then you can drag it up.
So that's the that. Oh,
Well, just because you put it on top of it, just click on it again. And don't click, drag it up. You can find it.
How do you reverse? How do you reverse?
you should be able to.
Double click on it.
It's gone. It's gone. You can't
No,
click
it's
on
your
it.
overlap to copy. Or maybe I'll delete it. Yes, you overlap to see that's why it's double click.
It's still there. What did you do? You double click
Yeah, double click it.
and then you drag.
Because you see, you put it on top of each other, it overlaps. So that's why you can't see. You did the right thing, but you left it lying.
Mm.
So you just double click it unless you can see it. Then you just drag it.
And put it wherever you want.
Yeah, you can do it again if you want. So all you gotta do, I'll show you one. Control C, yeah?
Yeah.
So right hand just leave it, just hold on to it,
Yeah.
and then click left,
Mhm.
and then drag it out. Yeah,
So you're holding Control C and then you drag it.
And when destination,
Yeah.
you just paste it, do you?
No,
It's-
you just.
It
That's
says
drawing.
my demo count is invalid.
And demo count is invalid.
So now Control C.
you got internet
What
working?
you do?
Sorry?
is
The
you
internet
have
is
a
working?
swing block,
Yeah,
and
it
then
seems like it's
you-
working.
so you only have one.
And I've used it before.
And then you just.
From the up.
Yes, it's invalid.
So that's a swing block. So
Once
then you
it's the same
place
thing,
it
I'll
there.
do something record.
So then you're moving
Once it's the same thing.
this, then
Oh, you
that,
can just file, just
and go and.
ask for another demo account,
Yeah.
it'll give you a new one. Just say file new account.
That double click
Yeah,
and
demo.
it just disappear.
Yeah, okay, any last questions?
That's what you're selecting it, but then
Ah.
they think you selected, so it's now.
No.
One
Next
so
week.
it's selected.
What we are teaching next week.
What are we teaching next week? Probably we can just go through a bit of more indicators, I think we should be fine there.
Next week.
Yes,
It's on YouTube. When you film this, where do you store it?
it should go on YouTube actually, yeah, we'll send a link out. It should, theoretically you must.
Yes, but where? It's
So if you
not-
miss
it's not
it-
for public, it's not for public use,
No.
you need to know.
Then we have to send the link out to them.
Yeah. No, it's for
We will send.
So if you miss a coaching session, you can still say,
Several ways for you to catch up.
It should theoretically, I'll check the machine.
it You get it?
I
Yes.
just wanted to capture all the ones that I've missed.
Oh,
Yeah.
I think some of the previous ones.
Let me try and see if I can copy.
Because it's good at technology, man.
Yeah, no, because I looked into Google Hangout.
Yeah,
This
it's
is a webcam.
yeah, it's such a nightmare.
Yeah, I use a webcam. So I thought, oh great, I could use Google Hangouts so if I don't get here on time.
Yeah.
Who's doing the 9 o'clock one?
I think with Sushil is doing okay. I think he is logging on to
Around
it
the corners.
online. Yeah, no, I'm not doing that. I think we should send a recording. Over, any questions?
I just want you to. Now, sorry.
Any questions at all?
Please select it. Sorry, I'm busy now. Any questions about it? I have to deal with this.
Okay.
But I think thanks very much the way you went through it.
Yeah,
And to revise it and think, make it safe.
Okay, no worries. Did okay, so we'll start next week.
Dig my old.
What was you doing basically a copy? Or you
Yeah.
could- I'm
Everything okay with you?
Yeah, okay.
Yeah? Okay, this is very good, yeah. You coming for the Forex conference, MSF Forex conference?
So you can continue copy,
16th of June, 16th, we should send an email out. Are you getting our emails? You're getting our
No, I
emails?
didn't get it.
Remember,
No, I mean, you, generally when we send emails, are you getting anything?
I got many things.
Okay, that's all.
Okay.
We'll send one, we'll send one.
Yeah, send on.
Yeah, 16th of June.
Okay, 16th of June. Send me on.
that's it.
Yeah.
Monday, isn't
You
it?
can adjust it so the top is.
Yeah.
Yeah. 16th.
Okay, see you later, Sushil. Take care, bye. See you next week.
Something like this.
Yeah, covering the art.
Okay, Philip, bye-bye.
Okay, take care.